Okay, welcome back to the show. It gives me great pleasure to reintroduce Mr. Simon Lambert, the editor of thisismoney.co.uk. A very good morning to you, Simon.
Morning.
If my memory serves me correct, you're a Watford fan.
I am indeed.
And I know that Zach has just said off air, is Elton John still involved? Right? That's what he knows about football.
That's what I know about Watford. That's not bad. Vicarage Road, what else do you want?
No, that's perfect. It's perfect.
Two things, two key
Pretty
points.
good.
Have they still got the allotments around the side?
They did, yeah. I mean, there's a lot of stuff that's been going on with sort of trying to rebuild bits of the ground and then things stopping and starting in recent years, but, you know.
Is that sort of, as they sort of reintroduce a new manager? How many are you up to this season?
We're on 4 managers this season so far, yeah.
And how's the latest one looking?
Good. We done very well. We were top of the table. We've slid down to 5th now after losing 2 games, but so maybe we need a new one.
Didn't the season only just start?
Well, no, 12 games into it. Well,
A couple of months ago?
Yeah.
4 managers in a couple of months.
Yeah, they've had some troubles.
Clearly.
So another one, I can be leader of the Labour Party and a manager of...
That's worse than Tesco.
Yeah. Right, let's talk serious stuff. Simon, you suggested we talked about mortgages and interest rates today. What's on your minds? Is this a good time to be taking out a mortgage? Should I be fixing? Are rates going up sooner rather than later? Or?
Well, this is actually a pretty good time to be looking for a fixed rate mortgage. Rates had climbed earlier this year. We'd seen some incredibly low mortgage rates the end of last year. You could fix your mortgage for 5 years below 2.5%, which is incredibly cheap money. You need a big deposit to do that, but even with a smaller deposit, you could be fixing for 5 years around sort of 3.5%, and that is still very cheap money. Rates had climbed slightly, but now they've fallen back off the back of the expectations for a rise in interest rates being pushed back now to potentially beyond the general election. There's the troubles in the Eurozone, low inflation coming into play, and also the fact that lenders brought in new, tougher affordability-based lending rules in April. That dramatically slowed down the market, and now they look like they're trying to play catch-up.
So if I wanted, though, to borrow for something like 10 years, how long can I borrow for?
Well, you could fix your mortgage for 10 years for 3.49%.
Wow.
Yeah.
I mean, okay, I wrote in the Times today how I think bond markets, which effectively mortgages are priced off bond markets. And I wrote in the Times today that I think bond markets, and therefore by necessity mortgage rates, are underestimating the threat of inflation, because inflation for about the last 30 years has averaged just below 3%. So if you're a believer that, you know, of mean reversion, we will go back to historical averages, then actually you're effectively borrowing 10-year money at 0.5% real. I mean, that's extraordinarily cheap money.
That is extraordinarily
I mean, it's just amazingly cheap
Yeah.
money. It's only just above our long-term inflation rate.
The problem with long-term fixed-rate mortgages in this country, though, is that they haven't really taken off because people are concerned that they're going to want to do something in those 10 years.
With their money.
They're going to want to move home or something, and that they'll be locked into it. Obviously, you can take a long-term fixed-rate mortgage with you. It is portable, but the bank's going to want to reassess your new property. If you want to borrow more money, they're going to want to do that on a different mortgage rate. So actually, our long-term fixed-rate mortgages have never really taken off. But if you're living in, say, for example, your forever home and you know you're definitely not going to move, then a 10-year fix at under 3.5% is astonishingly cheap.
That's astonishingly cheap.
A couple of points here. The fact you didn't mention was challenger banks. I mean, is that driving down the prices of mortgages as well?
It is, yeah, and we've seen challenger banks, the building societies really competing. The big banks are competing as well. There was a period of time when the big banks weren't competing quite as well for mortgages. But I think that what borrowers need to remember is that they're in a bit of a sweet spot here. There's a lot of people who are still sat on standard variable rates, which fell when the base rate fell, and those look typically around 4 to 5%. Now, some of those borrowers could actually simply remortgage now to a 5-year fix or even a 2-year fix and start saving money right now, and that's before interest rates start rising. At the moment, that horizon for interest rates has been pushed back because everybody's thinking that bad news is going to come and things are going to surprise on the downside. But equally, things could actually become better than we think. The economy could continue to pick up. The Eurozone might do QE. Inflation might pick up. All of a sudden, those mortgage rates are going to start rising again. So for those people who do know that they need to remortgage and they know that when interest rates start rising, they're going to start paying more, this looks like a really good time to fix.
Well, there's two things. One, we have the Bank of England's quarterly inflation report tomorrow, so it'll be interesting to see what they say about base rates and when they're going to change. A lot of people had expected...
But you won't know after tomorrow because Mr Carney doesn't know.
Well, Mr Carney, no. But what is interesting is one of the reasons why the markets that had been pricing in a rate rise by the end of this year have now pushed it back to sort of August next year is because of the German slowdown, the Eurozone slowdown, and the worst inflation numbers. You know, again, we have third quarter GDP from Germany and the Eurozone on Friday, expected not to be a great number. However, if the German slowdown is purely temporary, then you start to get Europe starting to recover again. Like you said, you know, actually that August rate rise could actually start coming back earlier into the year again.
And the other thing they're looking at is, for example, you know, there's a talk that the Eurozone will have to do QE, a proper form of QE. But what they've already done with buying asset-backed securities is based on the funding for lending scheme that we did here. Now, it's not really going to work quite as well as funding for lending in the way that it is, but if they tweak it, it might suddenly start working like that. And nobody expected funding for lending to work as well as it did. And it did work because basically it pumped a load of money into the housing market, and the housing market drives the UK economy. If the Eurozone and the ECB manage to do something surprising like that, and surprise can happen, look at Japan, you know, the other week, then you could suddenly find that those rate expectations come a lot closer, because ultimately we can't keep interest rates at 0.5% on the floor forever, because the point of emergency measures is you use them in an emergency. They don't become a permanent fixture.
And actually that TLTRO, which is the European Central Bank's version of the funding for lending scheme, the September amount was terrible, but the amount that banks may take in December is expected to be a lot higher. So again, exactly what you're saying, that, you know, there's a number in December when we find out, and I've forgotten the date, how much European banks have taken, and that basically it's the same as funding. They'll get cheap money in order to lend it back out again. So we'll wait and see if that works in Europe.
But my gripe about all of this, very simple, is that I earn 50 grand a year, okay, and I think I'm paying £1,500 a month in rents. I want to have a mortgage, okay. Am I going to go along there? Are they going to be intrusive? Do they want to know my pet bill in terms of food, okay? Do I need to have a whopping huge deposit, okay? And is it, you know, is it fixed for 25 years? I'm now 50. Could I get a mortgage? Oh no, sir, you've got grey hair. You've got to be, you know, the perfect model, tick all the boxes to get to borrow money.
Even worse, there's an admin fee. It's like, you know, you've got a 0.99% for 5 years, but there's a £3,000 or £2,000 admin fee, which ruins the whole. Which means your effective rate is like 3 or 4% or 5%. Is that something you've looked into?
Well, there's no denying that it has become harder to get a mortgage. So the new rules that were brought in April have introduced, they've forced affordability-based lending on lenders. But a lot of them were already doing that anyway. But they are asking these much more intrusive questions. And it is true what you read about some of the slightly strange things that they ask people. And people who are more than capable of repaying their mortgages and are probably paying more in rent than they would be on the mortgage, being turned down for mortgages.
Yeah.
But it is not impossible to get a mortgage.
Right.
They ask about the hamster and the goldfish.
Yeah, you've got to tell us the weirdest question. What's the weirdest question?
The weirdest one I've actually had was not necessarily a question, but it was somebody's bank who, because they'd held their bank account for so long, it was before the proper digital records, and the bank would not release its own records to the mortgage lender because the person had had the account for too long. Oh. So the only way to get round it was to open up a new account, which obviously would have damaged his credit rating.
Outstanding effort.
But an arrangement fees are a big issue. So as rates have fallen, banks try to claw the money back with larger and larger arrangement fees. It's that side bit of finance, isn't it? You bring the rates down, but you charge people a higher arrangement fee. But there are fee-free deals out there, and there is a situation where if you take into account the rate and the fee and compare mortgages doing that, which we have a calculator actually on This Is Money to do. So if you go to thisismoney.co.uk/calculator, it will do it for you. You can still find that you're going to be saving money. And I think that what stops a lot of people from remortgaging is inertia.
Yep.
and the thought of, I don't have an hour and a half to spend on a mortgage interview, but that hour and a half can pay off to the tune of thousands of pounds a year.
We've run out of time.
I want the
No,
question.
I'm sorry. We're going to have to. Well, Simon will be back in 2 weeks' time, and if you're lucky, you'll be here as well. No, the production team is shouting at me. We're well over. Listen, we could talk to you for ages. You know that. Okay, that's Simon Lambert, the editor of thisismoney.co.uk. We've got to take a really, really quick break, and then we're going to go back with Mr. Tom Elliott, international investment strategist at De Vere Group. We'll be straight back.